This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. We have a special show this week. We actually have a guest joining us. Yes, someone else will be speaking other than myself on the Value Investor Podcast. So Zacks Director of ETF Research, Nina Mishra, is joining us to talk about everything that's going on in the value ETF world because, believe it or not, value ETFs are hot. Yes, we're finally hot, everybody. And we are the big winners here in 2021. Now, on prior podcasts, I have discussed various value ETFs, how you can, invest in value using ETFs, which ones were out there and available. But this show, we're gonna cover all the hot ones and what ones you should be watching. And maybe we're gonna discuss whether or not it's too late to get in now. Has the run already happened? I know all of us value investors can be real pessimistic about these kind of rotations when value does get hot because it seems not to last real long. But I feel like there's a little bit more momentum this year than we normally see. So this could last longer than what we've seen in the past. I hope so, fingers crossed. But there's a lot going on with value ETFs this year. And so now we have the expert. So welcome to the show, Nina.
Hi, Tracy. Thanks for having me on. It's a very interesting topic. So I'm very excited to talk about it.
Yeah, me too. So I'm just going to start off with all the money is rotating into value now, right? Since it's the hottest sector, is that right? I'm like laughing because
yes.
I find it hard to believe that could be happening.
Yeah, right. So value has underperformed growth. Value had underperformed growth for over a decade. And since September, value actually started outperforming growth. So if you look at the performance of the Vanguard Russell 1000 value ETF and compare it to the Vanguard Russell 1000 growth ETF, you will see that the value ETF is up over 36% since September of last year, whereas the growth ETF has gained just about 18%. So this difference we had not seen for the past so many years, and it is really exciting. And it's the value ETFs which have been gathering a lot of assets this year. Last year, we saw that technology and emerging technology stocks and ETFs were getting a lot of love from investors. But this year, we are seeing a lot of inflows into value ETFs, into financial ETFs, not so much into energy, even though energy is the best performing sector. But energy, as we talk frequently, energy has been hated for such a long time. So that is why we haven't seen so much impact on energy ETFs. But financial ETFs have gathered a lot of assets, and value ETFs, like one of the most popular value ETFs, VTV, it has gathered almost 9.5 billion in assets. So this is really exciting and the start of a new trend. Whether it continues, it remains to be seen.
Right. That Vanguard value ETF you just mentioned, the VTV, that 9.5 billion in inflows, that would put it into the top 5 for the year. Is that right?
Yeah, in terms of inflows, it is one of the top 5 ETFs, which is very, very impressive.
Yes, and I want to remark that it is actually beating the ARK Innovation ETF. That's the Cathie Wood one. That's the darling of all investors. The ARKK one. That's only brought in 6.6 billion so far.
Which is really surprising because the ETF is down for the year. It is down about 10%, but investors, there are many Cathie Wood fans out there, and we do not know. Maybe in the longer term, ARKK will outperform. Cathie Wood has been saying that the inflection point will be here soon. So we do not know, but if you compare inflows into ARC ETFs and value ETFs, you see the big difference this year, because last year ARC ETFs were the big market darlings, and they had done very well. So the investors chase performance, so they were just putting money into ARC ETFs. ARC was one of the top 10 ETF providers. They had climbed the ETF leaderboard, the ETF providers leaderboard, and they had become one of the top 10 ETF providers at the end of last year. And now they have slipped from that spot. They are no longer the top 10.
Okay. Now, why do you think the Vanguard Value ETF is the one value that all the money is flowing into? Why is this one of the most popular with inflows this year?
So this is a very cheap ETF. It charges just 4 basis points, and very popular. It has over 83 billion in assets. So this ETF and similar value ETFs, which are very cheap and very popular, and plain vanilla, simple to understand, they are used by advisors in the ETF model portfolios. And ETF model portfolios are becoming very popular in the last few years. So that is why we have seen a lot of inflows into value ETFs that are cheap, popular, and plain vanilla. Though there are some other value ETFs, which we will discuss later on the show, which have done even better. The small cap value ETFs, the pure value ETFs, but they haven't gathered as much assets as the plain vanilla cheap value ETFs like VTB.
Yeah, it makes sense. If you are new to value investing, or you just want to move some quick money in there, you're just looking for like the basics. And that's what this ETF reminds me of. I looked at what areas it's in. So financials is the biggest sector with 21.7%, then healthcare at 17.7%, industrials are 13.7%. And I did look at energy, but it's just 5.1%. It has 338 stocks. So it's not huge, but it's a little bit bigger. And then I looked at the top 10 holdings, and these are some of the names that, again, if you're looking for just kind of the basic large cap value, you would get some of these. So Berkshire Hathaway is in there, JP Morgan, Johnson & Johnson, United Health Group, Procter & Gamble, Bank of America, Comcast, Exxon, Intel, and Verizon. Those are the top 10. And that's about 20% of this ETF. So this is like a basic kind of, just you want some value, so you're getting in it.
Right. This is one of the starting ETFs that investors can use, especially investors who are new to the ETF world. This is a great ETF. And talking about the sector exposure, if you look at the sector performance, energy is actually the best performing sector this year. It is up almost 47%. And financials is actually the second best, but a distant second if you compare the performance of energy and financials. Financials are up about 30% this year, but most of the outperformance of value ETFs, especially large cap value ETFs like VTB, is being driven by financials and other sectors like industrials too, because energy has become such a small part of major indexes. Energy had been underperforming for the past 10 years, and also because of the new trend of investing in ESG, many investors exited out of energy stocks and ETFs. So just imagine where this ETF would have been if energy was a larger part of the portfolio.
Yeah, it would really be on fire, and it's already hot. Okay, let's switch over to maybe some more of the niche players. So I wrote this down because I saw this the other day, and so it reminded me of this podcast. So if you want to hit a home run instead of a double, then you got to go for more of these aggressive niche players. Even in value, we have niche players. So some of those have been killing it, as you already were referencing. And a couple of those I've talked about on the podcast before. So one of those is the Invesco S&P Small Cap 600 Pure Value ETF. That's RZV is the ticker on that one. And this one is among the hottest ETFs this year, is it not?
Yeah, so this is a very interesting ETF. It invests in small cap stocks with the strongest, purest value characteristics. And this is one of the top performers this year. And there is another ETF similar by Invesco, and that is the ticker symbol is XSVM. It is the Invesco S&P Small Cap Value with Momentum ETF. So it looks at value and momentum, both factors. That has done even better this year. That is, one of the top performers in the value ETF space. But those ETFs are not very popular with investors. They are smart beta ETF. They use slightly little bit more complicated methodologies, and they are also slightly more expensive because of this enhanced indexing that they use, the smart beta indexing that they use. But if you want to look at ETFs that invest in purest value stocks and with a small cap tilt, then these are the ETFs you should look at, RZV and XSVM.
So the XSVM, the one with momentum, what is the difference there? Like, what is driving that outperformance? Is it still the financials, the same as it would be with the RZV, just the pure value without the momentum? Or does that one have more exposure to energy? Do you know?
So this has, the top sector is actually consumer cyclical. So it is, I guess it has benefited from outperformance of some of the meme stocks too. In fact, I see that GameStop is the top holding currently. And compared to the RZV, it has higher exposure to industrials and technology as well. So some of the technology stocks which have done well, and people talk about tech rack and all that, but technology is. Many technology stocks are at their all-time highs. In the large cap space also, if you look at Google and Facebook, they are close to all-time high. NVIDIA and some of the smaller technology stocks have also done very well. So this ETF, which has larger exposure to consumer cyclical and technology, it has done even better than RZV, but it with such a large exposure, more than 10% exposure to GameStop, it is a bit risky.
Yeah, that's a little crazy there. But I noticed that Bed Bath & Beyond is also in the top 10. It's only 1% of the holdings, but that's kind of been a Reddit stock as well. And then I see that there's some agriculture and energy stocks in there, which is interesting. And those definitely have had momentum for sure. So that makes sense that they would be in here. So that's kind of cool. I didn't know that these momentum funds exist. Now, does this one have similar expense ratio costs as the RZV? That one is 0.35%, which is a little bit pricey.
So this is 39 basis points. So this is also pricey because both these ETFs, they use enhanced stock selection and weighting methodology. So because of higher indexing costs, these are slightly more expensive. And talking about meme stocks, in fact, RZV also has a little bit of exposure to Bed Bath & Beyond. At least till yesterday it had, though a very small part. So, all those stocks were small cap value stocks earlier. So maybe they will go out of these ETFs at the time of next rebalancing, because they are neither small cap stocks. Many of them are not small cap any longer, and they are certainly not value any longer. So some of these stocks will definitely go out of these ETFs at the time of next rebalancing. And there's another, ETF which invests in purest value stocks, and which I like, which is cheaper too, but this is also not very popular. It is called the iShares Focused Value Factor ETF. Ticker symbol is FOVL, and this is cheaper than RZV and XSMB. This has an expense ratio of 25 basis points, but this also tries to select the stocks which have the best value characteristics, and this has exposure to all large cap, mid cap, and small cap stocks.
This is more of a catch-all type of one.
Yes, right.
How many stocks are in that one? Is it small, or I'm trying to look at it?
Let me take a look.
Because I know that there's 168 in the small pure value ETF, and so that's why it's so much more concentrated, because they can actually find that many value stocks. It's on some of these other ones where it's 600-700 or whatnot, that there aren't that many value stocks really. But this one, they have the whole.
This has 42 stocks.
482. Okay.
Sorry, 42.
Oh, 42.
Yes.
Oh, that's super concentrated. Okay.
Yes.
So yeah, you're really going for, the more deep value here, most likely with this one.
Right. And if you want to look at a more diversified pure value stock, which is not too expensive, this one by Avantis. It is Avantis US Small Cap Value ETF. Ticker symbol is AVUV. And this is an actively managed ETF, and it tries to look for small cap companies with the best value characteristics, uses some fundamental criteria, and has an expense ratio of 25 basis points, which is very reasonable for an actively managed ETF. And this is quite popular, 1.3 billion in assets, and has gathered a lot of assets this year too. And this has a much more diversified portfolio. If you are worried about the concentration in the earlier ETF FOVL that we discussed, this has more than 660 holdings. So a very well diversified ETF, not too expensive, and looks for pure value within small cap space.
Okay, cool. Yeah, I've not heard of these ones before, but that is intriguing to get an actively managed one, especially with value heating up here. You might want to have just some kind of manager who knows what they're doing, trying to find the winners here.
Yeah, so that is why it has gathered more than 500 million this year itself. It has the total assets is 1.3, and out of which more than 500 has come this year itself because of outperformance of value and small cap.
Yeah. Okay, that's interesting. Now, there is also a pure value ETF for the S&P 500, right? Invesco has one of those, ticker RPV. So if you're interested in not just having the small cap with that kind of pure play, you can do this one for the S&P 500, right?
Yes. So this looks for purest value stocks within the S&P 500. So large cap, mostly large cap space. And this is also done better than plain vanilla value ETFs like VTV. But this is also, this has the same expense ratio as RZV, 35 basis points. So you spend a little bit more, and you get a little bit more concentrated portfolio than VTV. This has 122 holdings. So Invesco has this suite of pure value and pure growth. Pure value is called RPV and pure growth is called RPG. So they take the S&P 500 space and they divide that into 3 buckets: pure value, and in between is the blend, and then pure growth, RPG. So RPG was one of the best performers over the past decade, and this year RPV has taken over. after being ignored for past so many years.
Right. Well, it's about time. That's what I say.
So I had a question for you. So I read one comment by a market expert that this kind of rotation into value we had seen at the time of internet bubble burst, and that at that time the rotation lasted for at least a couple of years. And he said that we may see this trend again because last year technology was so hot, but we haven't actually seen tech correct this year. As I mentioned earlier, some of the technology stocks are still at their all-time highs, touching new record highs. So do you see the similarity between this value rotation and the value rotation that you must have seen at the time of internet bubble burst?
I would say no, for the reason you just gave, is that we haven't had the tech bust yet. I feel like this rotation is just going into the areas that have underperformed because they've underperformed, but they're not going into it as like a safety play necessarily. They're going into it because it's cheap, but they're not, in 2000, it was like, I can't be in tech, everything's crashing. So I'll just put my money over here into, a bank or something to keep it kind of safe. But now with everything still trading, near the all-time highs, there hasn't been some kind of big tech wreck yet, as you mentioned, or even a bust really. So people are just trying to find, maybe the next hot momentum areas. And it just does happen to be a lot of these value type sectors that we mentioned, like financials and energy, because they have been just so underperforming the last couple of years. So I kind of feel like this is a rotation inside a bigger bull market still, different than 2000 when we were heading into the bear market. So everybody does go into value in bear markets, but this one is like a surge in value within a bull. Also, we did see some of that in the late 90s in the drug stocks, and some of the transports did real well at the end of the 1990s as well. So that reminds me of this rally a bit. But some of these, banks, nobody really wants to be in those, but someone is this year because it's
exactly
so much. And then energy, even though it has been huge this year, when you do look back on like a 5-year chart, it's still pretty devastating. Like I looked at the XLE ETF, and I think that's still down on the 5-year chart, like 17% versus the S&P 500 being up 100% during that 5-year period. So that's pretty devastating underperformance, even with, the big gains. So it's going to take a while before people believe at all in certain sectors like energy, I think.
Yeah, right. Yeah, it has been very, very painful for energy investors. So it would take some time for these sectors to recover. And that is one of the reasons why energy has become such a small part of major indexes. Yeah. And talking about energy and value and small cap, there's another ETF which has done very well this year. Okay. So it is the Invesco's S&P Small Cap Energy ETF. Ticker symbol is PSCE. This is up almost 90% this year. Wow. But if you look at past 5 years performance, it is almost half. Almost half. So for long-term investors, very bad. But those who entered this year, it's been pretty good. So I in fact do not even know much about the holdings of the ETF, the smaller energy companies, which are doing very well this year.
Yeah, I did look at some of these. I know all these because I do follow the energy. So these are the usual names. They're not all E&Ps. Some are just in services within small cap energy as well. But this is very concentrated. So yeah, if you're looking for a way to just play the energy rebound and you want the small guys, not Exxon and Chevron, then you are getting quite a nice variety in this ETF, I feel.
Yeah, True. And plus the performances. So if we believe that oil can continue to rally, then probably the ETF is definitely worth a look. And there was an article in the Wall Street Journal recently that option traders are now betting that oil will go to $100. So if you believe in that, then this ETF is definitely worth a look.
Yeah. Now, how are the fees on this one? Is this one more pricey too?
Yes. So this is 29 basis points, so slightly cheaper than RCV, but still more expensive because of its unique exposure. So it's, again, a part of Invesco suite and 29 basis points in expense ratio.
Yeah. Well, this would be one that you're probably not going to hold for a real long time. You're just kind of playing the energy trade here on the reopen and, that kind of thing. So you're not maybe as concerned about the fees on that one because you won't be in it long.
Right. Yeah, for your core portfolio, which you want to buy and forget, and then obviously a value ETF like VTV makes more sense, in addition to core S&P ETFs like VOO and VTO, or the total market ETF like VTI. But this is definitely worth a look if you believe that oil can continue to rise.
Yeah. So should value investors be scared that all this money is rotating into it? Is this like a sign of the top since they are popular this year?
So I would say it's not a sign of the top because value has underperformed for the past so many years. So probably this trend can continue. And this year is very unique because everything was shut down last year. And now with vaccinations and reopening, economy is rebounding so strongly that the growth rate that we will see, the GDP growth rates that we will see this year, probably we haven't seen in years. So obviously value and cyclical stocks will do better. And also because technology and growth stocks did so well last year. So probably they need to take a breather, though they can continue to rise. But I think this trend of rotation into value will continue for some time.
Okay. I like ending things on optimism. Yay! And value, we've been waiting so long for something to be optimistic. And we're finally getting it this year. So let's hope it continues. Yay. Let me recap all the tickers we talked about because some of you might want to go and investigate some of these if you are interested in the value ETFs. So we had the Vanguard Value ETF. That's just the big one that we were talking about, the basic one, VTV. V as in Victor, T as in Tom, V as in Victor. Then the, let me see, I'll do the Invesco Pure Value ETF. So the small cap 600 Pure Value is RZ as in Zoo and V as in Victor. Then the S&P 500 Pure Value ETF is R, P as in Paul, and V as in Victor. Then we had the Momentum Small Cap Pure ETF, which is intriguing. That one is X, S as in Sam, V as in Victor, M as in Mary. XSVM is that one. That's the one with GameStop. Then we had the iShares Focus, that's FOVL. So F as in Frank, O, V as in Victor, L. Then if you want actively managed, which it looks like a lot of people do because some money is going into that, that's the Adventus actively managed small, is that small cap? Yeah. Value, which is A, V as in Victor, U, V as in Victor, AVUV. And then we talked about the energy, which is a value right here, even though I think the forward P on that ETF is like 47, but that's to be expected because the E is still on the rise there as oil rises. So that one with the energy is the Invesco Small Cap Energy ETF, PSCE. P is in Paul, S, C is in cat, E. So I think that covers all that we've talked about today, and there's a lot going on. So make sure you subscribe or get us somewhere. We're on Amazon Music, we're on Spotify, we're on Apple Podcasts, we're on a couple other places, but be sure to get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.